Let's get in Sandipan Roy, Chief Investment Officer, Motilal Oswal Private Wealth, and Nitin Shanbhag, Head Investment Products at Motilal Oswal Private Wealth, to talk about this. Gentlemen, both of you, thanks for joining in. Interesting that you observe what a few people have spoken about, but with adequate numbers, gentlemen, about how the quarter was, particularly on the breadth and the nature of the stocks that have moved. What were the key insights here? Either of you can start.
So maybe I'll go out. If you look at the way the year has panned out, fiscal year 2024, and if we take the top 500 stocks, which is the Nifty 500 universe, we find that almost 90% of this universe was delivering positive returns in the first quarter, which is between April to June 2023. And by the time we got to Jan, February, March, we had only 50% of the stock universe which was actually delivering positive returns, right? As we tapered off towards the end of the year, we found that it was predominantly the large cap universe which continued to do well in terms of positive returns, whereas a whole host of stocks, almost 60 to 70% of the universe within mid cap and small caps started generating negative returns. So that was one insight that we took in terms of the breadth of the rally, right? The second insight was the performance of these market caps throughout the year. So if you look at fiscal year 2024, the markets kind of topped out around end of January, early February 2024. And during that time period, obviously mid and small caps did extremely well. And perhaps half that universe actually gave more than 50% return. 20% of that universe actually doubled. But when we look at the last 2 months, which is February and March, again, we find a similar story where 70% of the large cap universe was actually positive, but about 2/3 of the mid and small cap universe actually gave negative returns. In fact, 20% of that universe actually fell more than 15%. So these are the two predominant areas in which we saw a shift in tides, and that's why we've even titled it that way.
Yeah, no, so
yeah, please carry on.
Yeah, no, so what we have been talking about from the beginning of the year has been that mid and small cap is where we are seeing some bit of froth building up, and hence staggering investments is what we had been recommending, not knowing that there will be some regulatory interventions also, apart from the market fatigue that naturally builds up. While large cap is where we had been saying that you should go into a lump sum. And that has been kind of vindicated, albeit it's a short-term period. But the thing is that we remain structurally bullish on the markets. The earnings growth will drive the markets. But yes, some bit of focus has to come back on picking up stocks as the breadth is really narrowing.
I wonder though, I mean, when I look at page number 10 of your presentation, you guys talk about the valuations relative to forwards, and yes, the mid-cap P relative to the Nifty P 10-year averages as well, substantially at a premium, but not so much for the small cap end, right? So prudent to say that maybe there could be pain valuation if valuations were to correct and the mid-cap end, but not necessarily in the small cap universe, or that's not the correct way to read it?
See, in many ways, small caps is also a function of liquidity, right? And given the the low float that is available within the market, right, valuations there matter quite a lot more than they would in the mid cap side, right? For many reasons, the mid cap stocks have also not corrected as much because it's a defined universe of 150 stocks as per the SEBI categorization. The small cap is a fairly broad universe. So rather than looking at the index per se, what we are trying to say is that it would be best to focus on quality names, and hence mid and small caps from an investment perspective now onwards needs to be far more bottom up in nature. And we are saying that for select strategies, both in mid cap as well as small cap, given where we stand currently in terms of valuations, it would be preferable to stagger your investments out over a period of the next 6 to 12 months.
Also, in small cap index, I think it is not fully correct to look at the EPS earnings of the index. You will notice that even in the graphs that we have shown, there are spikes both on the upside and on the downside when the index constituents get changed or there are earnings revisions on a back-ended basis that happen. So not always the earnings on the index gives a correct indication, and hence we need to look at stock-wise and not just on the index. Large caps, again, as we have emphasized on, the valuations are actually lower than in the last 10 years average, and the earnings growths have been quite positive, and we are quite optimistic on the earnings growth. So the PEG ratios, which is something that we have been tracking very closely, that remains very attractive for the large caps.
Okay, okay, fair point too. Just one final question, and that is around the sector rotation. Now, is this, to your mind, something that will always happen in a cycle, wherein at some point of time when the cycle has run its course, there will be a shift of hats and the underperformers will start outperforming? Or are there some specific reasons why this is happening to some of the sectors this time around?
We believe that sector rotation is always part and parcel of any market cycle. In fact, market cycles are actually starting to get shorter. And that's purely on account of the dissemination of information, the efficiency that we have with the advent of social media channels, so on and so forth. So just to mention that point, over the last fiscal, some of the sectors which otherwise did not participate in the early half of the rally have started to participate in the last quarter, predominantly your banks, NBFCs, auto and healthcare. And a couple of sectors which actually were performing in the initial phase, like power and infrastructure, have started to lag. At the same time, two sectors distinctly have maintained pace. The first amongst them is real estate. And Neeraj, you would remember that we've been fairly constructive on that space for the last 6 months to a year. And the other has been capital goods, because now we actually see the advent of the capital capex cycle coming into place, and it's a long gestation cycle, but these are two areas where we continue to remain fairly bullish.
At the same time, some of the laggards have continued to remain laggards. Banks per se, have not yet caught up. So while there should be a catch-up rally at some point, where the entire market rebases, I think this cycle it's all about growth, be it on the earnings growth, be it on the order book growth. So given that animal spirits, I think sectors where we don't see too much of earnings growth momentum, I think will continue to remain laggards for fundamental and liquid reasons. Yeah.
Gentlemen, a very small conversation on what is always a very interesting monthly note. We'll make amends the next time. We'll have to wrap it up on this show today, though. Thanks so much, both of you, for joining in.
Thank you.